Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax regulations to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're back in Washington, D.C. in PwC's Policy on Demand studio, where I'm excited to have Steve Kohart back on the podcast. Steve is an international tax principal in PwC's New York City office and previously served as advisor to the Center for Tax Policy and Administration at the OECD. Steve, welcome back to the podcast.
Thanks a lot for having me.
All right, Steve. So before we dive into the fifth round of administrative guidance, if you can believe this, we're on the fifth round. We recently celebrated the U.S. Super Bowl here. First of all, who is your NFL team?
I'm afraid to admit this in public, but it's still the New York Jets.
Well, you know, you gotta support your team. So I respect that. So I was in London last week and I got a question and I wanted to pose it to you. What is the allure of American football and why did 135 million Americans watch the Super Bowl? I mean, was it just for Kendrick Lamar?
I'd say it's about, I think as Americans, we like, instant gratification. Having spent some time living in Europe and watching European football, I can see the allure to American football. It's action-packed. It's a couple of games a week. More than 3 or 4 points go on the board in a game. I can see it.
All right. Yeah, I'm a little bit bitter, as an NFL fan living in St. Louis over the course of my lifetime. And this is really hard, particularly for Europeans and really the rest of the world to understand that I've had two teams taken from me over the course of my lifetime. Originally, the St. Louis Cardinals became the Arizona Cardinals, and then the LA Rams became the St. Louis Rams, and then became the LA Rams. But I still did watch the Super Bowl. And I described it as, it's really like a family experience. I had my mom over and, it's just an opportunity for everybody to get together and then eat ridiculously awful food. And I did have a food hangover the day after the Super Bowl. I would also encourage people to Google Rotel and Velveeta, which is from another planet, but also very American. All right, so we're not going to turn this either into a food or a sports podcast as much as I would like. What we're here to talk about is the OECD released in January of 2025, its fifth set of administrative guidance. I don't think this is the last administrative guidance. We're going to see, and we're going to talk about when we may see the sixth round of administrative guidance. But I think there were four kind of major components to the administrative guidance. And I wanted to start with the administrative guidance on 9.1 of the model rules. I try very hard, Steve, not to use what we refer to here in the U.S. code sections and sections. 9.1 is thrown around a lot. First of all, remind listeners, what is 9.1 before we dive into what the AG said?
Sure. So Article 9.1 is the transition rule that applies when a group becomes subject to the GLOBE rules in a jurisdiction for the first time. Because of the fact that the GLOBE rules key off of deferred tax accounting to bridge temporary differences, we need essentially an opening statement for purposes of the GLOBE rules with respect to deferred tax items that may be relevant for the GLOBE calculation going forward. And Article 9.1 provides a general rule that says what's ever on your balance sheet coming into the GLOBE rules is generally going to be good for purposes of your future GLOBE calculations, albeit if it's at a rate higher than 15, you need to recast to 15. But importantly, there are some caveats that come later in Article 9.1 that apply to denying a step up or an effective step up on an intra-group transaction that happened after November of 2021. And then also importantly, and we're going to talk a bit about it later, I'd imagine, denying a deferred tax asset for certain transactions that happened during the transition period that may have given rise to a deferred tax asset related to something that would have been excluded from GLOBE income or loss. And I know there's a lot there, but big picture, It's the transition rule into the GLOBE rules with some really significant carve-outs that might not allow you to access an item of deferred tax that you otherwise would have been able to.
Yeah, and they were very mindful that they wanted to prevent taxpayers from effectively doing a step up, so to speak, of the assets that would otherwise create a deferred tax asset in the time period between when those rules were announced, so November 30th, 2021, to when the rules actually came into play. So that rule was built into the initial rules. But what was the OECD concerned with that sort of gave rise to this latest administrative guidance?
Sure. So we don't see jurisdictions by name in the latest round of administrative guidance, but it seems what they were concerned with was Bermuda and Switzerland and the way that those countries would potentially be applying the rules given their domestic tax systems. Because again, those items of deferred tax are generally recorded based on differences between financial accounting and tax results in a country. And in Switzerland, there were apparently taxpayers that may have booked non-refundable tax credits that could give rise to a deferred tax asset, as well as folks who may have gone back who previously had a low rate ruling and may have gone back and said, well, as part of Swiss corporate tax reform, I should have taken a step up because of the fact that Pillar 2 was coming. So to go back and retroactively make that change. Bermuda, on the other hand, because it had no tax system before, introduced a new domestic minimum top-up tax, or really a corporate income tax, right? Because it's not a QDMTT. And there, taxpayers had the ability to take fair value basis in certain assets going into the tax regime for the first time. And to the extent that you have an asset with no or low book value and now fair value tax basis, you'll put a DTA, generally speaking, on your financial statements that, absent additional guidance, would have been a good attribute for Pillar 2 purposes.
So in those jurisdictions, there was no transaction that created the deferred tax asset that took place between that November 30th, 2021, and when the rules came in. It was, in Bermuda's case, sort of the nature of the system and how they, with the new corporate tax system, allowed taxpayers to take a deferred tax asset. And then in Switzerland, and this I don't think was really new in Switzerland, but it effectively allows taxpayers to record that deferred tax asset potentially for a transaction that predated the November 30th, 2021 time period, but then they recorded the deferred tax asset after those rules were announced. So what does the administrative guidance tell us with respect to those DTAs, Steve?
Sure. So with respect to those DTAs, they said that they're going to essentially expand the scope of Article 9.1.2, because again, Doug, to your point, right, the model rules require a transaction. And in these cases, there wasn't a transaction, right? In the case of Bermuda, for example, right, they just made a policy choice that they weren't going to tax historic appreciation and value before the tax system under their new tax law. But the guidance said that essentially these attributes will not be good for Pillar 2 purposes to the extent that one of three criteria are satisfied. So sort of expanding that scope of Article 9.1.2. I think the first two were targeted at Switzerland with respect to an agreement with the government that gives rise to the DTA, so a tax credit agreement in the transition period, or to the extent that you go back and make a retroactive change to an attribute that adjusts taxable income for a prior period. So for example, going back a couple of years and changing from a low rate to a step up and then having that amortization roll through your domestic tax. And then that last category being essentially, DTAs that arise in connection with a newly introduced tax system during the transition period. Again, they don't name countries, but clearly that one seems to be aimed at Bermuda.
Right. But there was also a grace period. Tell us about that.
Yes. So there was a soft landing, so to speak, in this guidance, because just to remind listeners, right, this guidance came out in January of 2025. These rules had been live in Switzerland for a year already under the QDMTT. Folks had reported were in the process of finalizing their 2024 financial results. So there is a bit of a soft landing in the sense that for 2024 and 2025, for 2 years, you can use up to 20% of the attribute, either for the safe harbor calculation or the full Pillar 2 calculation. So, we don't have many adjustments to the safe harbor calculations in terms of the taking what's on the financial statements in the numerator, but this is one of them, right? In that, even if we're applying the transitional CBCR safe harbor, if you have one of these attributes, you'll need to test, have I potential, do I project to exceed that 20%, and then making the adjustment for your Pillar 2 calculation.
I will remind listeners that, because you mentioned this came sort of at the very end, or the very, obviously in January. So as companies were doing their sort of year-end provisions, this is just administrative guidance. This is not enacted law, right? Each jurisdiction is going to have to enact this and bring this into their domestic legislation. But certainly those public filers will need to be mindful if they did take those positions in 2024, if that legislation does get enacted in 2025, presumably that will need to be reflected in the 2025 financials. But just a reminder for listeners that I think sometimes we get so tied into the administrative guidance, we forget that, well, actually each of these sovereign countries has to enact these particular rules.
Absolutely. And what's interesting with Switzerland, because, they're clearly, in the crosshairs of this guidance, is that they've taken a reference approach to this administrative guidance where it gets incorporated in Swiss law as the guidance is issued, or at least that's the approach that the government is taking with respect to the guidance. I think some real questions about how exactly that works and when we have retroactive rules, but big picture, I think that's the starting point. There are certainly some questions around it. But I think important, Doug, to your point, with respect to administrative guidance, looking at what's the jurisdiction that's impacted and what's their process for getting that administrative guidance into the domestic law, and then how do they plan to apply that either prospectively or potentially retrospectively.
Yeah, and one of the things that the OECD did say that if a particular territory allows for this deduction in their domestic minimum top-up tax, that it would not be a qualifying domestic minimum top-up tax for the safe harbor. We're going to talk a little bit about this new central record, but important to note that if a particular jurisdiction would allow the deduction, it would it would kick them out of the qualifying status. There was also some sort of moving on or related. There was some guidance with respect to deferred tax assets from tax losses that are greater than 5 years old. What did the OECD say there?
Sure. So again, because the model rules key off of deferred tax accounting, the general rule is to get credit for a DTA related to a historic loss. You need to have a deferred tax asset either recorded or disclosed in the relevant financial statements for the transition year. But if you're in a country with a 0% rate or with no tax system, you wouldn't have had anything recorded or disclosed in your financial statements. Right. So for folks in a country like Bermuda that had no tax system, they otherwise wouldn't have gotten credit for their historic losses. The Bermuda system, when it came online, gave credit for some historic losses. And then as a result of that, it follows that because there's now a tax system, you may be able to book a DTA in your financial statements. And what these rules said is essentially that you can get credit for up to the last 5 years of losses coming into the rules. So essentially putting a cap on that period looking back with respect to losses that may have been incurred.
All right, so let's move on to, there was guidance mentioning future related benefits and guidance on what is a related benefit. One of the things that the OECD was concerned with was that policymakers in respective jurisdictions would potentially change their incentives, for example, to maybe move things above the line, for example, to be able to allow to still harbor tax competition and to create foreign direct investment. And the OECD was very concerned about particular jurisdictions sort of creating related benefits to effectively offset the potential tax from Pillar 2. What did this latest administrative guidance tell us about this?
So there's some foreshadowing here. There's a statement that said, while this guidance addressed particular fact patterns, there will be guidance in the future more generally addressing certain types of tax credits and incentives. And they made reference to credits and incentives that are tied to either income or tax in a jurisdiction. And that's not entirely shocking because we look at the definition of a qualified refundable tax credit, which is a good tax credit in the Pillar 2 model rules in the sense that it gets taken into account in both your effective tax rate numerator and denominator. And the commentary there has always said that the credit needs to be effectively refundable, right? It can't be a non-refundable tax credit that's dressed up as a refundable one. So we've always had that to go with. So it's not surprising to see them say, look, we're going to target credits that are tied to measures of income or tax, because that generally means you're going to need to have a tax liability in order to use that credit, which potentially makes it non-refundable under their definition. But, I would caution that I think it becomes a slippery slope as you start to, think about, well, what's a good credit or incentive? What's a bad one? And especially when we're starting to get into things like refundable credits and cash grants, just where and how you draw the line and where and how you measure what's an acceptable level of credit and what's not.
Yeah. As an example, Steve, the U.S. research and development credit, everyone I think that listens to the podcast knows is not a good credit for Pillar 2 purposes. Well, if the U.S. would then change that, which they won't for a number of reasons that we've articulated on the podcast in the past, but hypothetically, if they would amend that to make that now refundable because they're trying to react to these Pillar 2 rules, is that a related benefit because it wasn't before and it was changing? That's a rhetorical question.
Right. And then there's even the question of the U.S. doesn't have a QDMTT as of today, right? So a related benefit to what?
All right. So lots of still unanswered questions. I'm going to ask another challenging one. So shortly after this administrative guidance was released, there were some comments about additional anti-abuse rules made by Jeff Mitchell from the OECD at a Washington, D.C. bar conference. Can you paraphrase or at least kind of share sort of at a high level what he said?
Sure. So there were comments made about future administrative guidance with more anti-abuse rules. We saw in the December 2023 administrative guidance where we got the hybrid arbitrage rules that we discussed on a prior version of this podcast, that there would be similar rules brought into the full version of the GLOBE rules. And I thought, many folks thought those rules might be coming with this round of administrative guidance that came out in January.
Yes,
those weren't there. So I think some of these comments were addressed at that, but they went a bit further, listing some other types of transactions that might not have been caught by the hybrid arbitrage rules that came out in December of 2023. But I do think that, there are going to be some significant challenges getting additional administrative guidance, especially around anti-abuse rules, agreed, at least in the near term, at the inclusive framework, given that, we now have a new administration in the U.S., and the U.S. is a member of the inclusive framework. And, in theory, this is a consensus body.
Right. And let's unpack that for a few minutes, and we can dedicate an entire podcast to this. But I do want to cover the other areas. But we had Will Morris on a recent podcast. We talked about the executive order from President Trump, which said that the U.S. was not going to be supporting the OECD's Pillar 2 efforts, barring action from Congress. We know we're not going to see any action from Congress. And so that I think the likelihood of new administrative guidance, given the U.S. position, could be more challenging. But what is, Steve, the process that the OECD must go through to get out administrative guidance? Because I think one of the challenges that I have, we say it's a consensus process, but it feels more like unanimity than consensus based on they want the major economies, for example, the major jurisdictions to all agree. What formally is that process from your experiences there?
For sure. So, the members of the inclusive framework all have an opportunity to provide input on that guidance. And then the OECD is effectively the policy funnel to get that agreed outcome out in the form of administrative guidance. I've gotten a lot of questions around, well, might they just go ahead without agreement from the U.S.? And, while anything is possible in the future, I think given the comments we've seen from the administration on day one, no less, right? This is a day one issue. I find it hard to believe, at least in the near term, right, that we would see that escalatory step.
Right. And we know that the U.S. administration is kind of armed with this Section 891, which gives the ability to be able to retaliate against discriminatory taxes by the president to increase withholding rates. Congress has proposed Section 899, which is Defending Jobs and American Investment Act, which will give sort of an automatic increase in withholding for discriminatory taxes. So it does feel like the U.S. is kind of arming up, so to speak, in this tax war to potentially retaliate. And it certainly appears reasonable that the OECD may pause before giving it additional administrative guidance that could, impact U.S. multinationals adversely. So the question then is will we see additional administrative guidance, and when could we see additional administrative guidance?
Yeah, so I think it'll definitely, at least in my mind, it's more likely to come after we see some form of a resolution with respect to the UTPR as it applies to U.S. multinationals. That, clearly is a day one issue for the new administration. We've already seen European officials quoted saying, look, we're willing to entertain a conversation on this with the U.S. with respect to the UTPR. And then I think the question is, do they get to a landing on that? And then as part of getting to that landing, does the U.S. decide to stay engaged in this process?
Right. All right. So we'll continue to monitor that very closely. I think, as many of us predicted, 2025 is going to be an incredibly dynamic year in international tax, obviously with Pillar 2. And then we're also anticipating U.S. tax reform, which will be the topic of a future podcast. But no shortage of stuff for us to talk about, Steve. Okay. Let's move on to maybe some of the last sort of interesting areas, but still really, really important for taxpayers. And I don't want this to get buried, because particularly as we talk about some of the tax compliance. But let's start with this, what the OECD called the central record of Pillar 2 legislation with transitional qualified status. First of all, Steve, why is qualified status important? Just remind listeners sort of how this structure works and how the rules work.
Sure. So to the extent that a jurisdiction has a qualified domestic minimum top-up tax or a good QDMTT that meets the requirements to apply the safe harbor, that means that no other jurisdiction's Pillar 2 rules will apply to that jurisdiction. So if country X has a good QDMTT and it's owned by a company in country A that has an income inclusion rule, that income inclusion rule is turned off with respect to the subsidiary country because the QDMTT is safe harbored. Similarly, if a country is applying a good income inclusion rule down the chain that's qualified, that turns off the undertaxed profits rule, or the UTPR, applying to those entities that are subject to the qualified IIR.
So the OECD told us that there were 28 countries that had good qualifying domestic minimum top-up tax. I'm not going to list those here. There were 27 income inclusion rules that had good, that were qualified for purposes of this transitional qualified status. But then the OECD also told us that the transitional qualified status ends once a full legislative review is completed. What does that mean, and how is that process going to work?
Sure. So I think they realized that they needed to get something out early so that taxpayers could have some level of certainty with respect to, is a set of rules qualified? Can I rely on the QDMTT safe harbor, for example? But at the same time, they haven't gotten through a full review of the relevant domestic legislation. So this process allowed for this transitional qualification status. But I think what they're flagging is that, hey, we're still going to do a full traditional peer review over the next 2 years. And that as a result of that process, we'll make a final determination as to whether or not a country's rules are qualified. I think important to note that taxpayers can have relative certainty with respect to the period of time between the effect of the rules and the completion of the peer review, because they've said that essentially that future full and official peer review will apply prospectively.
Right. So a loss of the transitional qualified status will not be retrospective. And I think that was very helpful. What about those 20 plus countries that were not included on that list?
Sure. So just because a country's not on the list doesn't mean it doesn't have a qualified set of rules. It seems as though they prioritized the folks who turned their rules on from 1/1 of 2024. I noticed a lot of 2025 QDMTTs weren't on the list, and I suspect that just has to do with the order in which they got to these. So I wouldn't say because a country's not on this, and I think they even said that, because a country's not on the list doesn't mean it's not qualified. It likely just means that they haven't gotten to it yet, because I suspect everybody who's implemented a QDMTT has done so in a way that they're aiming to obtain that qualified status for the safe harbor.
Yeah, one of the other questions that I've received and have seen some in the tax press is that, is it possible, given the U.S.'s position and what we recently talked about with the executive order, that there could be review of whether guilty in its current form is a qualifying income inclusion rule? I'm not going to ask you to speculate on that. I think it's an interesting question given some of the history that we've seen, and some particularly with the Biden administration. But I think this is going to be something very interesting, both with respect to see, does the OECD change its approach with the U.S., and then how does the OECD continue to review countries And then as additional countries come online and as new countries come online, do they start to change their strategy with respect to how they're implementing their domestic minimum top-up taxes or income inclusion rules? All right, so let's move on to, this is one of my favorite topics, is the globe information return. Before we dive into some of the technical mechanics, and this might be, Steve, the most important thing that I'm asking you, is the globe information return appropriately abbreviated the GIR, or is it the GRRR? One of our colleagues calls it the GRRR. I'm not trying to lead the witness here. I'm a GIR kind of guy. What's your view?
I'm in the same boat as you, Doug. I'm a GIR person because I think it's clear. And, in our profession, we work with a lot of folks where English might not be their first language. But I've always been FDII and not FDII. And I know I'm probably outnumbered on that one as well. So, we can go with both.
I'm with you on FDII, or I'm with you on FDII as opposed to FDII as well. But, now with some of the guidance that we're actually going to talk about and some of these additional rules, I am slightly persuaded that maybe just GRRR is more appropriate than GIR. All right, so Steve, what did this new information on the globe information return tell us? Because we had a schema, an XML schema that was previously published. We also got, we're not going to dive into a new XML schema to reflect these rules, and also some additional user guide for tax authorities, which is some very interesting reading as well if people are interested in sort of the technology and how that works. But what really was the substance and the takeaway for taxpayers with respect to the new globe information return?
Sure. So I'll start with the mundane, which is that they updated it for a lot of the administrative guidance that we've gotten through December of 2023. But I think the most interesting development was the fact that they said generally, and we'll get into why I say generally, but generally that the GIR will need to be filled out in accordance with the OECD model rules and not the relevant local legislation that's potentially applying in a certain set of facts. And there's a number of exceptions to that we can chat about. But big picture, I think our starting point, right, is that instead of filling out the GIR using the relevant local taxing rules that may be applying the local implementation of Pillar 2, they want you to fill it out in accordance with the OECD model rules, which I think is quite novel.
Right. And then it also goes on to say if there are any differences between the model rules, so presumably that includes model rules, commentary, all the administrative guidance. If there are any differences, then those differences also need to be disclosed as part of that schema. So a couple of takeaways I have from that, Steve. The first is that this requires now 2 calculations for every jurisdiction where you're applying the full model rules. So it's the model rules, and then it's also a calculation based on that jurisdiction's particular rules. So additional compliance burden. I think many of us were hopeful that the things were going to be simplified when we got sort of this final and latest globe information return, and I think this really just complicates things. The second takeaway that I have is that it really makes the transitional safe harbor important, right? Because if taxpayers can meet the transitional safe harbor relying on their country-by-country reports, then it sort of prevents them from having to do those 2 calculations. So making sure you have a qualifying country-by-country report, things that we've talked about on the podcast, becomes very important to help limit that administrative burden. One of the things that the OECD also mentioned is that acknowledged that some countries could have constitutional or administrative law constraints on accepting data that does not correspond to their domestic legislation. In other words, you can only request information related to laws, not this kind of hypothetical model rule calculation. So what did the OECD tell us about that?
Sure. So I think to the extent that a country requires you to use their local rules under their relevant standard, it'll need to be reported that way in that country. I think, also important, the guidance did carve out a couple of exceptions, right, in addition to that. So I think, they said base case, right, use the model rules, and then, here are the exceptions to it, right? That being one of them where there's a local legal or constitutional requirement to use a different mechanism. But then I think also helpfully, they said to the extent that only one set of rules is applying. So to the extent it's a QDMTT, right, or to the extent that all of your subs in a jurisdiction are under only one income inclusion rule, you can potentially fill out the GIR using the relevant local legislation instead of the model rules. But this just adds so much complexity, right? And especially for taxpayers in the US or, any other large economy, India, China, right, that hasn't applied the rules from the top down. When you have countries that are applying the UTPR, for example, you'll be doing your GIR based on the model rules because there's multiple countries applying the rules. And then you'll be having to check each UTPR country to see, well, do I also need to, because of their local constitutional or legal standard, fill this out in accordance with the local legislation? And the same thing goes for large multinationals. And this is a really common fact pattern, Doug, as I'm sure you know, right?
Oh, yeah.
That you have multiple holding chains, right? And it's not unheard of to have, a subsidiary in country A sitting under IIR number 1, right? And a subsidiary in that same country down a different holding chain where a different IIR applies. So we're going to see a lot of complexity here as a result of this.
Yeah, and I, as a shameless plug for our Pillar 2 engine, I think that taxpayers that want to comply with this and technology, and I think the OECD just kind of thinks that every taxpayer has access to technology that can do this and make this automatic, so to speak. And I think for taxpayers that are starting to now think about their compliance deadlines, knowing that the Belgium QDMTT, for example, is due in November for those calendar year filers in 2025, with the looming ultimate compliance deadline in June of 2026, that you having a technology and a rules engine that understands and that can map out and create these various outputs, whether in XML or other formats. Technology is the only way that taxpayers are going to be able to do this, because trying to do this, for example, in a spreadsheet environment, I think creates a lot of control risk. And it's going to be very interesting to see how taxpayers and tax authorities too manage all of this potentially disparate data and disparate returns. And so having some technology that can manage all this, I think will be really critical. All right, so let's move on to the last piece. And again, this could be its own podcast itself on this Model Competent Authority Agreement, or the MCAA. Why is this important, Steve? And what did this particular guidance tell us?
Sure. So I get this question a lot, out in practice, which is, how am I going to actually file my GRRR? Where am I going to file it? Where am I going to have to file QDMTT returns? And there's been this push for centralized filing, right? We see that in the model rules where we talk about a designated filing entity and potentially countries engaging in exchange of information agreements to share the relevant portions of the GRRR to the taxing rights. So this is an effort to facilitate that. And we've seen it in Europe as well with the proposed DAC 9 directive. I still think there are going to be some real challenges around this, right? We've seen it with CBCR, where in theory, right, we should only have to file one centralized filing, but in reality, we wind up with local filings. So, here I think in the ideal world, right, there would be one filing with your designated filing entity, and then the relevant countries would agree to exchange the information and the relevant portions of the GRRR. I'm still a little skeptical this is all going to work out, especially for the first year. I mean, we have filings that are going to be due in just a little over a year from now. So I think, and my shameless plug for our Pillar 2 country tracker, we have now live our registration tracker. And I think that'll be really helpful as time goes on to look at, well, hey, which countries am I operating in? Do I have a local registration requirement? Do I potentially have a local filing requirement? So I think a lot more to come in that space.
Yeah, and the registration point is good. These rules do not deal with that registration. To your point, like, hey, we're seeing in most countries that are implementing these rules, if not all, they have some form of registration requirement to let that taxing authorities know that a particular taxpayer will be complying and filing Pillar 2 returns. And so really critical that taxpayers keep an eye on that. This competent authority agreement is more for global information returns, presumably QDMTTs, other returns. I think there are still a lot of open questions that even if this is a qualifying competent authority agreement that effectively allows for the filing of one taxing administration and then I think automatic exchange within 3 years, the points that you raised with respect to the global information return, like, wait a minute, these could be different. Like, this is not going to be one standard return. For the constitutional administrative law that we pointed out, we could end up with a hodgepodge of different returns, and then do taxing authorities give rights and access to these other returns? Just a lot of open questions. So, Steve, what are some of the open technical issues in which taxpayers seek additional guidance?
Sure. So, in practice, right, we're talking to multinationals every day with how these rules apply. And I think there's a lot of places where we might see some potential relief in the future. The rules have, potentially unintended consequences in some place where we see ordinary course transactions yielding an answer that might not have been the policy intent under the model rules. And I think one thing we've seen a lot of chatter about is, might we see additional guidance in the space of Chapter 6, which is the guidance that deals with mergers, acquisitions, dispositions, internal reorganizations, and might we see some additional practical rules that could help avoid unintended consequences in the application of the rules? And then there's a whole host of other issues that we've seen talked about over the last 2-3 years, employee stock ownership programs, things like that, where the rules might yield a consequence that wasn't necessarily the policy intent. But I think the timing of when we see that is a big question. I think we're likely going to be waiting for a little while. And of course, all of this takes time to write and agree at the inclusive framework. And we've seen in the most recent comments from the OECD that there is still a real emphasis on potentially issuing more anti-abuse rules, hybrid arbitrage type rules, and those comments that we talked about earlier from DC Bar. So given that the inclusive framework only has so much time, and there's the US and the UTPR debate looming that needs to be dealt with, and the anti-abuse rules that they're talking about, limitations on credits and incentives, peer reviews, there's a whole host of competing priorities. And I think, many in practice are hopeful that we'll see additional administrative guidance that helps smooth some of these rough edges. But I do also wonder if we'll start to see some countries, as they apply these rules, hopefully starting to take some pragmatic approaches, because, we have model rules and commentary from the OECD, and then it's the ultimate countries that are applying these rules that are going to need to then take an interpretation and apply those rules in practice. So a lot of unanswered questions that we'll start to see, in year 2 of these rules applying, exactly how it plays out.
Yeah, we've certainly, the OECD has been hard at work, and we can't acknowledge that. And, we got some guidance, for example, for tax liabilities, that took a lot of oxygen out of the room. Certainly it does seem that the OECD is very focused on these anti-abuse rules. But there are a lot, to your point, of practical issues with respect to deals. ESOP's a great example where additional administrative guidance is needed. I think one of the things that I've seen as I've talked to taxpayers and practitioners from around the world is sort of acknowledging that as a U.S. practitioner, we're just used to get more guidance, right? Like it's the Congress puts out a statute and then the Treasury comes out with hundreds of pages of regulations often. I think in the context of GILTI, and GILTI is a fraction of the complexity of Pillar 2 based on U.S. tax principles, blended regime, but just how complex that is. And I think as a U.S. practitioner, well, just give us more guidance. Tell us how to apply these rules. And I think outside the U.S., that is not necessarily the norm in many jurisdictions. And I do wonder, just how much administrative guidance does the OECD even have the capacity, just from a technical perspective, to get out? There's obviously the political issue with the U.S. and other territories. And then at some point, do some of the jurisdictions just say enough is enough? Because I think many of them thought that there was going to be a finite amount of administrative guidance, the rules would be set, and everybody would be on their way. And as somebody who has practiced U.S. tax law for 26 years, the guidance never stops. There's always additional questions and things that need to be answered. So I think the OECD has a tremendously challenging task. I think many of us welcome additional administrative guidance, but to your point, I think the political challenges could be a very, very big challenge for us to be able to get this additional administrative guidance. So, Steve, always a pleasure talking to you. Great going through this 5th administrative guidance. We'll see when we get the 6th one. Hopefully it's not months before we talk again, but I think still a lot to monitor, particularly as new countries come online. And again, would plug the PwC Pillar 2 tracker for companies to be able to track both domestic legislation as well registration and other filing requirements. So thanks for coming on, Steve.
Thanks again, Doug.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Steve Kohart, International Tax Partner in PwC New York. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.